there. But let's shift focus to the hospital space now. In a recent note by Macquarie, they say cracks in the armour are starting to show. The report suggests that Indian hospitals' top-line growth has been primarily driven by rate hikes as volume growth continues to moderate. To discuss more on this report, Kunal Dhamesha, who is a senior research analyst at Macquarie Capital, joins in. Kunal, hi, good morning and thanks for being with us on the show. Tell us a little bit about your report. Why do you feel that there is a slowdown that we're seeing in the Indian hospital space, and what are the primary concerns?
So I wouldn't say it is a slowdown. I think we are just catching up with the historical mean. If you look at the long-term trend in terms of the inpatient admission growth, it has always been around mid-single digit for the industry. Now, COVID was a bit of a disruption. In FY21, the inpatient admission went down, and then they kind of started catching up, and hence FY22 and FY23 showed significant growth for the hospitals, and then FY24 again is normalization. So there was a pent-up demand due to COVID, and the international patients were also almost went to zero during the COVID time. Both these things kind of came back in FY22 and 23, which kind of gave the hospitals the above normal kind of demand. But that has been kind of normalizing now. And FY24, if we see the industry-wide inpatient admission growth is only around 5%.
Okay. So that's factor number one. The inpatient admission growth has come down to 5% last year versus about 25% in FY22 and 23, which was driven largely due to pent-up demand related to
Sorry.
What about the industry average revenue per occupied bed per day, which we call as ARPOP? That too had seen a substantial increase in the past couple of years. Can you give us some numbers on the kind of increase we've seen on the ARPOP, during the COVID period and its aftermath, and what can we expect going forward on that metric?
Sure. So I think if we remove the last 5 years, I believe the ARPOP growth in the industry was somewhere around high single digit. Now, if we add the COVID period, the last 5-year ARPOP CAGR is around 13%, around 11%. And if we just look at the last 3 years, the ARPOP CAGR is even been more pronounced at around 13%. So what we have done is we have tried to break it down to various drivers. And, there are 4 key drivers of the ARPOP. One is procedure rate hikes. Another is payer mix refinement, specialty mix changes, and average length of stay reduction. Now, average length of stay reduction is more or less very mathematical. If you look at all the large companies, ALOS has come down by around 1% CAGR. So out of these 11% CAGR, 1% is driven by ALOS. And then specialty mix has been driving low single-digit ARPOP CAGR. And if we also look at the payer mix, again, 2.5% to 3% would have been driven by the payer mix refinement. So we are left with roughly around 6-7% of the ARPOP CAGR in the last 5 years, driven by the rate hikes.
Okay, but why do you think the ARPOP growth rate will moderate? Why is it not possible to assume that we will continue to see an increase in the procedural rates?
So my sense is, the ARPOP, the procedure rate hikes are again linked to the insurance rate hike cycle. And insurance rate hike cycles are typically 2 to 3 years. The contract mentions 2 years, but the final rate hikes take around 3 years to take the impact. And we have just passed a big rate hike cycle by the insurance companies. And hence, I think from here on, it would be much more moderate. If you look at, so we have also provided data for the largest health insurance company, Star Health. If you look at their medical loss ratio in the last 5-6 years, it has sustainably gone up from 62 to 63% range to around 65 to 67% range, which directly means that there has been substantial rate hike which has happened. And in response to that, insurance companies have started taking premium hikes. But since we are, the rate hike cycle is behind us, I believe that from here on, it would be much more moderate in terms of rate hikes. Second, the sector itself is looking at significant capacity expansion. And when they open new facilities, they will be open to all kinds of patient, be it a CGHS patient or be it a cash paying patient. And CGHS or institutional patients are typically a low ASP patient. So that could lead to payer mix dilution, and hence the 2.5% CAGR through payer mix dilution that we have seen in the last 5 years could be much lower going forward. And then on a specialty mix again, because the capacity is expanding, hospitals will not be able to choose which kind of patient they want to do, which kind of surgeries they want to do. They would be welcoming everyone into the new hospital, and hence the specialty mix portion can also be lower. So combination of all this, in my view, would lead to lower ARPOP growth, and hence I expect the ARPOP growth to be more like 8-9%.
Okay, that's on competition, but there's also a lot of capacity addition, right, that's happening in the sector. Do you think that could affect profitability? And if yes, which companies or which stocks could it hit the most?
Sure. So I think we have highlighted that the next 3-year bed capacity addition within the sector is almost around 14,000 beds by the top 8 hospital companies which are listed in India. And this compares to only around 3,200 organic bed capacity addition which has happened in the last 5 years. So the capacity addition that we are going to have in next 3 years is 4 times what we have seen in the last 5 years. And typically, whenever a new hospital is opened, we have seen that it's a high fixed cost business, and hence it leads to negative operating leverage. A new hospital becomes EBITDA break-even at roughly anywhere between 40 to 50% occupancy level. So till that time, it continues to remain EBITDA drag. And within our coverage, within Apollo and Max Healthcare, Max Healthcare is going to expand the capacity by almost around 80% in the next 3 to 5 years. So I think the larger impact would be seen there on Max Healthcare, profitability. Versus Apollo is expanding their capacity by around 25%.
Max's capacity goes up by 80% in the next 3 years.
Yes. Yes.
And Apollo's is 25%.
22 to 25%.
Around that number. Okay, got it. You've also said in your report that you are meaningfully lower than consensus expectations. You've laid out the reasons for that, but just lead us through what the valuation picture is. What is consensus right now in terms of a PE? Where do you stand? And what has been the historical valuation multiple that has been ascribed to Apollo Hospitals and Max Healthcare?
So I think historical valuations is completely out of picture right now. I think both this stock would be trading way above mean plus 2 SD level of EV by EBITDA or PE, whatever valuation metric you choose. With respect to peers, the way I look at is I look at more from a region perspective, wherein we include the Indonesian, Malaysian, Thai hospitals as well. And the entire region right now would be trading at around 20 times EV by EBITDA on FY26 number. Versus that, Apollo on our EBITDA estimate is trading at around 27 times, and Max is trading at around 36 times EV EBITDA on our FY26 EBITDA.
Okay. We will thank you on that note, Kunal. Thanks for joining in and speaking to us on CNBC TV18. That's Macquarie Capital with their view on the Indian hospital space and how it's going to shape up.